Welcome to this special edition of Life Sessions presented by HDFC Life in partnership with ET Now. This year marks a proud milestone, 25 years of protecting India with pride. Over the last 2.5 decades, HDFC Life has not only safeguarded millions of families, but has also been a driving force in shaping India's financial security landscape. From being one of the first private insurers at the turn of the century to innovating across products and investment strategies, HDFC Life has grown in step with India's capital markets. Today, we're exploring the deep link between insurance and capital markets, a partnership that has only grown in importance as India's financial sector evolves. Insurance companies are not just providers of protection products, they are also among the largest institutional investors, shaping the growth and stability of markets. And to help us dive deeper into this story, we're joined by two eminent voices. Prasun Gajri, CIO at HDFC Life, and M.W. Kim, head of JP Morgan's Asia X insurance team. Together, they will take us through the journey of innovation, regulation and investment, and also opportunities that lie ahead for insurers as market makers. Right, Prasun, Mr. Kim, thank you both of you for taking the time out and speaking with us today. Prasun, if I could start off with you, tell me, how has the evolution of insurance products in India been, and how has consumer behavior changed with regards to those products?
Well, if you look at India prior to the privatization of the insurance industry, life insurance industry in particular, it was dominated by participating products. LIC has been a dominant player, continues to be the largest even today, but their product suite was dominated by participating products. If you look at the situation today, so primarily over the last 25 years, this entire product suite has changed meaningfully. Today, it's no longer just participating products being the big one. Today, you have a good mix depending on which company you talk, but every company has a good mix. So you have, obviously the participating structures continue, but along with that, you had the advent of ULIPs, which has become a larger part of the portfolio for a lot of insurance companies. We have had non-participating products with the guarantees inbuilt, which has become a large part of allocation for some of the customers per se. Along with that, we have had more sales in, say, pure term. You have more sales in annuities. So if you look at it, the portfolio of an insurance company has become far more balanced and more diverse than what it was prior to that period. So all this has meant two things. One, obviously the consumer has more choice. You can reach out to consumer depending on what the consumer is looking for, whether it's ULIP or a guarantee or a participating product, annuity, term. So I think that gives a bigger choice. Another aspect which this has meant is that each of these products have their own nuances as far as the way you manage the asset side of these products, because the underlying liability changes if you move, say, from participating to, say, non-participating. So there is a certain level of guarantee built into non-participating, so you would want to manage the asset side differently. So all that has meant is that there has been a big evolution in the way the insurance industry looks at the capital markets or interacts with the capital markets over these years. So whether it's becoming a larger part of the government securities market, development of the longer part of the yield curve, being a fairly steady participant in the Indian equity markets, development of the fixed income derivative market, early days, but yeah, becoming reasonable players in the AIF market in the domestic sense, and also starting to participate in newer age instruments like InvITs and REITs. So effectively, this evolution has meant not only there are more product choices, but it has also meant that the insurance companies are pretty much spread across the gamut of the entire capital market structure, which I think is a big change which has happened.
Mr. Kim, with your experience, zoom out to Asia from India and tell me, how is it that you've seen insurance companies actually evolve and participate or contribute to capital markets across the region? And more importantly, I mean, what's the scale and significance that we're looking at here with the linkages?
Right. So absolutely, the insurers emerges as a major players in the capital market, doing a lot of their activities in every different asset class. Please remember the two things. Number one is that the Asia insurers asset size is substantial, and the other one is that they have a very long duration liabilities. Therefore, overall the risk tolerance is much greater compared to the other asset managers. So for example, if we look at the India, the overall the size of the asset under management for the insurers exceeded already 740 billion USD, which is equivalent to the roughly 20% of India's GDP. If you actually look at this figure in China, Chinese life insurers stands at roughly 5 trillion USD, equivalent of the asset, which is equivalent to the 25 to 28% of GDP. So this figure in Korea and also Japan stands for roughly 60 to the 70% respectively. So the whole is that the insurance industry growing and contributing much bigger scale compared to the economy, and this growth normally goes with the economies. So that's why when you look at the insurance company, we try to look at the penetration, which is the comparing the size of the insurance premium over the GDP. So as long as that the GDP continues to grow, we would see the more asset gathering on the insurance sector, supporting this whole the financial market. Lastly, if we actually look at the why insurance industry is so important in this market development, please remember they have a very long duration liabilities, very big risk tolerance, which supported the big development of the government bond and also the corporate bond market development, also that supporting a lot of finance to the infrastructures, etc. So that is why we would see that the important as a most important asset managers in Asia.
Prasun, you touched about on ULIPs. Tell me, how have ULIPs sort of shaped the development of Indian equity markets in some sort of way?
See, if you look at the Indian equity markets, the narrative is a lot of retail participation, building up, etc., etc. Obviously, that is true. And I think Indian equity markets have come a long way. But if you look at it, one of the underreported stories in some senses, one would expect that in this growth, insurance has not really participated. But that is not true. If you look at the AUM of insurance companies in the equity markets, or if you look at that as a percentage of the market cap, over the last 10 years, insurance companies have been averaging roughly around 5% of the market cap. And during this phase, what we have seen is the market cap itself has increased possibly 2.8 to 2.9 times. So insurance companies during this growth phase have pretty much kept pace with that growth and continue to be around 5% of the market. And this is when only recently the regulator allowed some sort of equity derivatives, which will allow some hedging to take place. Now, if that hedging comes through, I think the exposures can rise further. So effectively with ULIPs, where the underlying asset class can be fixed income or equities, but equities is the dominant asset class, it has meant that insurance companies continue to be very relevant players in the equity markets, and more so I think it's a little bit more differentiated form of capital. As Kim said, it is long-term liabilities. So this capital is a little bit more patient. This capital is a little bit more long-term, and there are companies which prefer that kind of capital. So I think insurance companies do provide a sense of that stability to the market in the overall context, and I think that is going to continue and build over the next few years in my view.
Mr. Kim, you know, when you talk about insurance, and especially insurance companies all across the world pretty much, they're also sort of counterparties for structured products via banks. Give me some examples on how India perhaps can develop onto that.
Right. So the India market seems to be a very early stage in terms of the structured financial product adoption among the insurance company. If you actually look at the other market, insurance companies are very active, especially that they're using the three types of their derivatives, like credit-linked derivatives. So we normally say that credit-linked securities and equity-linked securities, and also bespoke derivatives for asset liability management. So especially market like Hong Kong and Singapore, insurers are very active using those structured financial products to enhance their investment return or to reduce the balance volatility. In other words, the better way of managing the risk. And I guess that that is actually in line with the adoption of the new solvency capital. So India is still not yet adopted advanced solvency capital compared to the other Asian market. But as time goes, we think that the Indian market will be more active to manage those financial products for their risk management tool, and also that enhancing the better return to matching their long duration liabilities in general.
Prasun, is there acceptability for these kind of products which Kim just talked about? Because, like he rightly said, India is still at a very nascent curve when it comes to our insurance markets overall.
It is. I think there have already been, one we can talk about is the development, for example, of the FRA market or the forward rate agreement market. See, when insurance launched our guaranteed products, the regulator had allowed us to use fixed income derivatives. So regulatory support has been there in this way. So what that meant was that from practically nowhere over the last, say, 7-8 years, we have seen this forward rate agreement market, which will now transition into the bond forward market with the new RBI guidelines, to roughly around a 3.5 lakh crore market. So roughly around $38 billion is the size of this market today, with practically every life insurer being a part of this market. If you put this in context, so what this market has done is two things. One is it's allowed a new innovation in the market on the insurance side. Secondly, obviously giving more choice to the customers. Introduce long-term guarantees as a part of the portfolio for every consumer. And at the same time, it has also shown how relevant, say, insurance companies are to the fixed income markets. Today, say, this 3.5 lakh crores is what? It is just hedging of our future cash flows which are going to emerge. So these are the holdings in government securities or whatever underlying is there, be it government securities or state government bonds, which the insurance companies are likely to buy over the next 2, 3, 4, 5 years. So effectively, future buying by insurance companies is already guaranteed. And this 3.5 lakh crores is roughly 3% of the overall GSEC outstanding today. So effectively, that gives you size and scale of this. So I think 2-3 things are required. One is, what product innovation can insurers come out with? What kind of products are available in the market? And then you couple that with what regulations allow at any point of time. And I must say, regulator has been supportive as and when the needs arise. Combination of all these three will determine how we progress on these structured products. But I think it's early days, but as he said, I think this is going to be one big market over the next decade or so.
But you at HDFC Life have been somewhat at the forefront of product innovation. Tell me a little bit about what the classifications are like, what the acceptability and size of opportunity could be.
The size of opportunity is obviously very large. I mean, as he clearly said that if you look at our AUM as a percentage of GDP, insurance premium as a percentage of GDP, I think there's a long highway of growth. So I don't think there is any debate around that. What we look at when the acceptability part is, I mean, whenever a new innovation has come through, we have seen the customer are actually accepting that. And it is becoming a part of the mainstream in terms of asset allocation from a customer's perspective. And to link it back to the asset side, if I look at, for example, the longer term liability products like a non-participating or pure term or annuities, that has led to a big change in the way the government securities market has developed over the last, say, 10-15 years. So just to give you some data points, for example, in year 2000, the longest tenor bond issued by Government of India was 25 years. This moved to, say, if I look at 2010, this was 30 years. 2015, this was 40 years. Today, the longest tenor bond issued by Government of India is 50 years. So in the last 25 years, the tenor of the longest bond has moved from 25 years to 50 years. And I must say, the life insurance industry, along with some of the other players, has had a key role to play in this. Now, let me give you another number. If you look at the securities issued which are beyond 15 years, right, that number used to be, say, 10 years back, roughly around 23% or so. below 23%. Last financial year, that number was almost 40%. So effectively what has happened is the development of the longer part of the yield curve has been seen in the last 25 years, both in terms of issuance of more longer term bonds moving from 25 to 50, and also by issuing more securities which mature beyond 15 years, thus allowing the government to have a better management of their own borrowing program. And along with this, if you see, the ownership of life insurance players has gone up during this phase over the last 10 years by almost 3 percentage points. So effectively the ownership is going up, the longer part of the yield curve is developing, and government has been able to issue longer term securities. And I believe life insurance players have played a fairly reasonable part in the development of this market. So I think if you look at from product innovation to this, I think it's a long cycle, but just goes on to show that this cycle is likely to continue, because more product innovation will mean more such changes and more such requirements, both in terms of what insurers would want to do on the asset side and what the banks or other market participants can offer to the insurers.
Mr. Kim, it's also important here to talk about the regulatory framework, right? Tell me how in other Asian markets has the regulatory framework only propelled the insurance industries forward, and what can India adopt from those markets?
Right. So the two things we probably monitor. Number one is about the accounting standard. So the many Asian insurers adopted a new accounting standard, the so-called IFRS 17 for liability and IFRS 17 for the assets starting from January 2023. So China, Hong Kong, Singapore, Korea follows that the new accounting standard. And we're actually thinking that the next few years, most of the other Asian insurers would follow this new accounting standard. That is aligned with the European insurers starting from 2023 to enhance that transparency in their financial disclosures. So we actually thinking that that would be the one metric we should look at it. And the other one is about the solvency capital. So the solvency capital means that the more like the actual cash on hand, so-called the economic capital for the insurance company under more the fair value measure. So the last 10 years, Asian insurers gradually adopt the new solvency capital framework, more matching with the European insurers. So the putting all together, we think that the accounting upgrade and also the solvency capital upgrade more toward that risk-based capital, probably we need to monitor. India tentatively scheduled to adopt that new accounting and new solvency framework starting from the FY27. So we actually look at those kind of development moving forward. Why this is important? Because that a lot of the new financial metric will move into the fair value approach. That means that the insurance company should be more active to reduce that the potential financial volatilities on the balance sheet or the earnings against this macro movement. To do that, the insurance company need to rethink about their asset allocation strategies, the meaning that the need to identify more accurately on the future estimated liabilities with a very similar duration and size of the asset. So in that perspective, when you actually look at the overall the Asian market after this adoption or the upgrade on the accounting and solvency framework, we would see that insurance companies very big participation into ultra long bond yield the bond. The reason being that the liability is very long duration, and also that the reduction on the more volatile assets to reduce that this volatility. So that is actually a key trend, and probably India to follow this practice.
Feasible?
Oh, absolutely. I have no doubts about that.
I also want to talk to you, Prasun, over about the new asset classes that we've seen in the last few years. AIF, InvITs, REITs. what role do they have to play, and what about the acceptability of these products to begin with?
I think the domestic insurance industry has a big role to play in both these asset classes. Let's take AIFs to start with.
Yeah.
I think there is a lot of clamor for more domestic capital to go into the unlisted space through AIF structures, whether it is through venture funds or private equity funds. I think that has already started to happen. And life insurance players have been active participants in that. Well, data is very difficult to kind of fully get, but our sense, looking at our own numbers and some of the peers we know, I think the total commitment to the private equity, venture capital space, etc., under the AIF umbrella would be to the tune of 4,500 to 5,000 crores already. And it is growing faster than your overall AUM. Why is this important? I think these kind of asset classes provide two things. One, they provide diversification to your listed market portfolios. And secondly, there is a likelihood of better returns you can generate from these over a period of time. I think it's very heartening to see, say if 10 years back, most of the domestic funds were not really looking to source domestic capital. They were all going outside India to source capital. It's very heartening to see now almost every large fund in India is looking to raise money from domestic players, and life insurers is their first port of call in that. I think that is a big change. So I think both things have happened. I think as insurers, people are more willing, given that it fits into their portfolio requirements, because these are long-term asset classes, giving diversification and possibly better returns. And from their perspective, domestic capital, where they don't have to explain the India story very clearly. So it's a win-win from both sides. Yes, we are small in the context of things vis-a-vis what the larger global players are in terms of allocating. But I think this is an asset class which is growing and will continue to grow very fast. Similarly, on REITs and InvITs, I think very young asset class. Only over the last 5-6 years, we have seen the emergence of this asset class. The regulator has been supportive, giving almost immediately leeway in terms to invest in this asset class. And again, difficult to get industry data, but our belief is almost every insurer is participating, and we at HDFC Life have been pretty much utilizing whatever leeway in some cases on REITs regulator allows us, and we are very active participants. Again, not that we want to participate in everything new which happens. I think it just fits into the overall liability structure of mine, because REITs by their nature are long-term asset classes, giving you good returns over a longer period of time, fits right into our alley. So I think from our perspective and life insurance industry's perspective, AIFs, REITs, InvITs will continue to make sense from an asset allocation point of view. And my sense is these asset classes will continue to grow faster than the overall AUM of the insurance industry.
Mr. Kim, Prasun rightfully highlighted how the insurance industry has been in the past and how long we've come. From your perch, just talking about India, what could be the opportunities and more importantly, even challenges, say in the next 10-year journey?
So I guess that going back to the principle of the insurance industry. So the life insurance in particular, the nature of the business is actually that the promise, the future, the return to the customer in most cases. So the insurance company need to think about the liability-driven investment in their asset allocation and product development in general. So we should make sure that the insurance industry should have a very sufficient asset class to matching the long duration liability. So I guess that the number one opportunity or challenge perhaps would be whether India insurance industry could access to the large amount of the different asset class to sufficiently matching the liabilities. So in many markets, we would see that the certain restrictions or the certain that the pain, the matching very long duration liability with the proper asset due to the limited supply locally. So we actually need to monitor how the regulation to evolve on that part. That's the one thing. And then the second thing is that we should also monitor about the solvency capital framework, because that every investment requires a capital charge. So the insurance industry need to think about the optimal way of the balance sheet capital allocation to matching the liability with the proper asset, maintaining very stable return for the other shareholder as well. So that is the key things that we should actually monitor moving forward.
Okay, Mr. Kim, Prasun, both of you, thank you so much for your time and this discussion. Thank you.
Thank you.
Well, that was an enriching discussion. Thank you, Mr. Gajri and Mr. Kim, for sharing your perspectives. What stands out is that insurance is not just about protection, it's also about channeling long-term capital into markets, enabling growth, innovation and stability. From product innovations like ULIPs to exploring new asset classes and shaping equity markets, insurers have been catalysts in India's financial journey. As we move forward, the combined strength of insurers, regulators and capital market participants will be pivotal in driving India toward a more resilient and inclusive financial future. Thank you for joining us on this episode of HDFC Life Presents Live Sessions partnered by ET Now. Until next time, stay informed, stay secure.